Hey everyone, welcome back to Corporate Decoder, the place where we slice open corporate filings to reveal the juicy bits. Today, we're diving into Itron Incorporated's latest report, and let me tell you, it involves a whole lot of money and a whole lot of banks. Before we jump in, if you like getting these no-nonsense breakdowns, make sure you're subscribed. We also have a Discord community linked in the description below if you want to chat more about these company secrets. So, what's the big news with Itron? They just inked a massive deal that could reshape their financial flexibility. Think hundreds of millions of dollars and a whole new set of rules for borrowing. This report, a Form 8K, is basically a heads up to investors about significant events, and Itron Inc. has had a pretty significant event. The main event here is a brand new credit agreement. Imagine it like this: Itron Inc. basically got a major financial refresh. They've updated their borrowing arrangements to the tune of $750 million. That's a lot of zeros. This isn't just a single loan. It's a revolving line of credit, meaning they can borrow money, pay it back, and borrow it again, up to that $750 million limit. This gives them a lot of flexibility for day-to-day operations, or what they call working capital and general corporate purposes. It also includes special pots of money for things like letters of credit, which are like guarantees for other companies, and a swing line facility for really short-term needs. Now, for the important part, when does all this money need to be paid back? The final due date is the 25th of September 2030. But here is a kicker: this date could be pulled forward to the 15th of April 2030 if Itron Inc. doesn't manage their outstanding convertible notes properly. Convertible notes are basically debt that can be turned into stock. So, it looks like their ability to handle existing debt could speed up the repayment deadline on this new deal. How much will this new credit line cost Itron Inc.? Financially speaking, it's tied to market interest rates. They can choose between two main types of rates. One is based on the Secured Overnight Financing Rate, or SOFR, which is a widely used benchmark interest rate. The other is the alternate base rate, which can be tied to prime rates or other benchmarks. On top of these base rates, they'll pay what's called an applicable margin. This is where it gets interesting. The cost they pay depends on how much debt they have compared to their earnings, specifically their total net leverage ratio. Let's break down this table. Right now, if their leverage ratio is greater than 3.50 times, they'll pay SOFR plus 1.75%. That's 175 basis points, or BPS as Wall Street likes to say. They also pay a commitment fee, which is like a fee for having the credit line available, and in this case, it's 30 basis points. But if they manage their debt well and the leverage ratio drops below 3.50 times, the borrowing costs go down. The spread becomes SOFR plus 150 basis points, and the commitment fee drops to 25 basis points. And it gets even better as their leverage ratio falls further. If it's below 2.50 times, they pay SOFR plus 137.5 basis points, and a 20 basis point commitment fee. And if they can get it below 1.50 times, the spread is SOFR plus 125 basis points, and the commitment fee is 17.5 basis points. So, the better they manage their debt, the cheaper it is to borrow. This is a classic incentive structure designed to encourage financial discipline. What keeps them from running wild with debt? Teresa's strict rule, a covenant, that limits their total net leverage ratio to 4.0 times. This means their total debt can't be more than 4 times their earnings before interest, taxes, depreciation, and amortization. However, Teresa's a bit of wiggle room. After a big acquisition, meaning one costing at least $150 million, they get a temporary pass, allowing them to go up by 0.75 for 4 quarters. This is common practice to allow companies to finance growth through acquisitions without immediately violating debt covenants. And who's on the hook if things go south? Not just Itron Inc. itself, but certain of its domestic subsidiaries are required to guarantee these debts. This is standard practice to spread the risk and ensure there are multiple parties responsible for repayment. This section just confirms that this whole new credit agreement is considered a direct financial obligation for Itron Inc. It's not a hidden or off-balance sheet deal. It's front and center and everyone knows about it. The actual full document, the nitty-gritty details of this credit agreement, is filed as an exhibit. It's a really long document and it details all the specifics of the deal, including who the banks are. We've got Wells Fargo, JP Morgan Chase, and BNP Paribas leading the charge. And signing off on this report is Joan S. Hooper, the Senior Vice President and Chief Financial Officer. This officially stamps Itron Inc.'s acknowledgement of this new financial arrangement. So, what does this all mean for Itron Inc.? Essentially, they've secured a substantial amount of flexibility to finance their operations and potential growth. The structure of the credit agreement with lower costs tied to better leverage ratios is a positive sign. It suggests management is focused on maintaining a healthy balance sheet. The inclusion of a temporary increase in leverage following an acquisition also shows they're planning for strategic moves, which could either be a great opportunity for growth or a risk if those acquisitions don't pan out as expected. The key for Itron Inc. Moving forward will be to manage their debt effectively and ensure any acquisitions are sensible and accretive to their business. The banks are clearly willing to lend them significant capital, which is a vote of confidence, but like any large debt facility, it comes with responsibilities and potential pitfalls if not managed correctly. Alright, that's our breakdown of Itron, Inc.'s latest filing. What's your take on these numbers and what they signal for the company's future? Do you think this new credit facility is a smart move or a potential trap? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.